So you want to start trading Forex in 2020? Well, here's how. Okay, so welcome back, and if you're new, make sure you subscribe because I'll be dropping a lot of Forex related content in the future and you don't want to miss out on it. But today I'm going to teach you how to start trading Forex in 2020. So this video is for complete beginners, or if you're just starting out and you've had a little bit of experience and you'll find out more, this video will be perfect for you. I'll be going through all of the basics from what is Forex trading actually, who trades it, the different technical terms, different types of Forex traders, and all the good stuff. So it's probably going to be a long video, and that means you need to have your pen and paper out, maybe a bottle of water, some snacks, and try not to fall asleep. So if you're completely new to Forex, you've probably seen a bunch of people on social media saying how they made 20k in their first 10 seconds of trading, and you could do it so easy as well. And the truth is, well, technically you can do it. It is possible to make that money in that amount of time, but you have to be very, 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 very lucky, and the odds are stacked against you, and you'll be leaving a lot of risk on the table. So the chance of you just watching this video and going to make 20k is very slim. But hey, you could prove me wrong. You could prove me wrong. So today I'm going to teach you how to start Forex, so you can be making that 20k later down the road once you master the concepts and you're profitable and consistent. So before we get into the technicalities, the specifics and the detailed terms in Forex trading, first we're going to answer the question, what is Forex and what does it actually mean? So the word Forex is actually an abbreviation for foreign exchange, and that simply just means exchanging one currency for another. So I live in the UK and I use the British pound. So if I was to fly to the US, I would have to exchange my British pounds for US dollars, and that's foreign exchange. And obviously you probably know that £1 is not equal $1, because each currency has its own individual strengths, and which is affected by the supply and demand for that particular currency. So let's say that a lot of people wanted to exchange their currency for a US dollar, so the demand for the US dollar would increase and the value of that currency would increase, and the shift in between supply and demand happens all the time. So the currency's value is always changing every day, every week, month, all the way down to the minutes. So that means the exchange rate between a pair of currencies will be changing all the time. So let's say that I want to exchange £1 for some US dollars, and in return I got $1.22. So the exchange rate of pound and US dollar is 1.22. And now this is where me and you come in, Forex traders, and we speculate whether this price of the exchange rate between two currency pairs will increase or decrease, and if we're correct, we make money, and if we're wrong, we lose money. And the first thing you need to know about Forex is that unlike stocks, the Forex markets are open 24 hours a day, 5 days a week. So there's a lot more trading going on for us. And there are many benefits of being a Forex trader. And I know a lot of people have the image of Forex being risky and it's just gambling, and you're much safer just putting your money in the bank, which is true, but Forex, there's a lot of potential, and if you're good and you understand the concepts and you're consistent, you can make a lot of money in Forex, and simply keeping a bank will just be holding you back. And with Forex, you can trade it anywhere in the world. It doesn't matter where you are, as long as you have an internet connection. So that means you're not tied down to one location. And if you want to go traveling for 3 years, you can go traveling for 3 years, and you can still make money along the way. And it also means that you become your own boss as well, because you now have no one to report to apart from yourself. So if you become a better trader, you would make more money. And also you can take a day off whenever you want. If you don't want to trade today, then don't trade today. You have no one to report to. No one's going to say, if you don't trade today, I'm not going to pay you, because you pay yourself, you make your own money. So if you don't want to trade for the whole week and just go somewhere and do whatever you want, you can do that. Obviously you won't make any money, but you won't lose money either, but you won't make any money. But you have the freedom to do that because you're in charge of your own self and you make your own decisions. And I forgot to mention that the Forex market is the biggest financial market in the world and trades over $6 trillion a day. So it's not bad. It's not bad, I guess. Okay, so for a market to be trading over $6 trillion a day, there's going to be more than just me and you in the market. So let me introduce you to the people you'll be trading with. Okay, so first up we have the central banks, and these are the big players in the game, and they represent their nation's government. So they have the power to increase or decrease the value of their own currency to help solve problems in their own economy. And the next we have the commercial and investment banks, which include banks from all sizes, from small to large, and they still make up quite a big population of the people who trade Forex, and they simply just exchange and trade currencies between them. And the next we have the hedge funds and investment managers, who still do make up quite a big population of people who trade Forex. Not as big as the banks, but they still make up quite a big population, and they simply just trade pensions and endowments with larger accounts. And after that we have the corporations, who exchange between currencies to buy or sell products and services in foreign countries. An example would be, say there's a corporation in the US who needs parts for the product they're making, which is located in South Africa. They would have to exchange large amounts of their US dollar for the South African rand. And underneath the pile of everything I've just said are the retail traders, which includes me, and if you start trading as well, it'll be you as well. And we simply just speculate whether the price of a currency pair will go up or down. If we're right, we make money. If we lose money. And we simply just trade the markets with our own capital, which is a lot smaller than all the banks and all the corporations and stuff. But don't get me wrong, I know I said retail traders at the bottom of the pile, but we're involved in a massive financial market that trades over $6 trillion a day. So I'm not losing any sleep. Now let's look at the currencies that people in Forex will trade, because obviously all over the world there are plenty of different currencies. So which currencies do Forex traders gravitate to, and what are the most popular? So in front of you now, you have the 8 major currencies. So you have the euro, the British pound, the US dollar, the Canadian dollar, the Australian dollar, New Zealand dollar, Japanese yen, and the Swiss franc. So these are the 8 major currencies, and a lot of Forex traders will be trading these currencies. But obviously you can't just trade the currency by itself. You can't just be trading the euro. It's got to be the euro against another currency. So we'll look into that in a second. But as you can see that each of these currencies have a 3-letter abbreviation that represent the currency. So in Forex we don't write the full currency name out. We only use the 3-letter abbreviation to represent it. So for euro we have EUR, British pound we have GBP, US dollar USD, Canadian dollar CAD, Australian dollar AUD, New Zealand dollar NZD, Japanese yen JPY, and the Swiss franc CHF. A lot of these abbreviations, you need to understand what they mean so you know which currencies you're looking at or trading. So moving on, these are the most popular pairs that Forex traders will trade. So again, we have the 3-letter abbreviations. So first you have GBP USD, which means the British pound against the US dollar. Then you have EUR USD, which is the euro against the US dollar. USD CHF, US dollar against Swiss franc. USD JPY, which is the US dollar against Japanese yen. AUD USD, which is the Australian dollar versus the US dollar. NZD USD, which is the New Zealand dollar against the US dollar. Then finally USD CAD, which is the US dollar versus the Canadian dollar. And these are the 7 most popular pairs, and they will have tighter spreads, which I will talk about later in the video, and they'll have more volume because there's more people trading it, so they're more volatile and more liquid. And again, I'll talk to you about those terms later in the video, but those are some of the reasons why people trade these pairs. And if you're just starting out trading Forex and you're a beginner, you want to be looking at these pairs to trade from, and I recommend you pick maybe 1, 2 or maximum 3 pairs to start with, and look around with these pairs and just try and understand them more and notice how they move together, if they move in the same way or they move in opposite ways, or when one does this the other does that, and just focus on 1, 2 or 3 pairs, no more than 3, because you might get overwhelmed. And when you're focusing on a few pairs, you can concentrate and fully understand what's going on in these markets. Now let's look at the minor currency pairs. So here's a few of the minor currency pairs. There are a lot more, but here's just a few. So we've got GBP AUD, we've got Euro JPY, AUD NZD, CAD CHF, Euro GBP, and NZD CAD. So this is just a few of the currency pairs, but if you notice that in the most popular pairs, every pair had the US dollar in it, had USD. In the minor currency pairs, the pair does not have US dollar, but the currency pair does have the major currencies. involved. So as you can see here, the euro, British pound, US dollar, Canadian dollar, all of these are the major currency pairs. And when you pair them with each other, like the euro and the pound, that's a minor currency pair. But if you were to pair euro and the US dollar, that would be a major currency pair. These minor pairs, a lot of people still trade them, but just not as much as these popular pairs with the USD in it. And I still trade these pairs. So I do trade the popular pairs like the GBP USD, Euro USD, and I also trade the minor currency pairs as well. And then finally, we've got the exotics. So the exotic currencies are traded a lot less than the major currencies, and they're a lot less popular. So I've got a few down here. You've got the Hong Kong dollar, HKD, the Turkish lira, TRY, South African rand, ZAR, Singapore dollar, SGD, Mexican peso, MXN, and the Norwegian krone, NOK. So these are all exotic pairs, exotic currencies, and they're traded a lot less than the major ones. So for us to have an exotic currency pair, we need to have a major currency partnered with a exotic currency. So for example, we could have Euro TRY, which would be the euro against the Turkish lira. And even though there is a major currency in that pair, because of the exotic currency, we call that pair an exotic. So another example would be GBP NOK, which would be the British pound against the Norwegian krone. And that again will be an exotic currency pair because of the exotic currency in that pair. Now these pairs are traded a lot less than every other pair. Now I recommend you stay away from these pairs when you're just starting out, because they can be unpredictable and they could spike up or spike down just in a quick change of the amount of buyers and sellers in the market. And if you're just starting out, you don't really want to be dealing with these sort of things. You want to be more focused on your 2 or 3 pairs that you've chosen and just understand them and see how they work and understand how price moves. Okay, so now I'm going to show you what an actual Forex chart actually looks like. So in front of you now, you have Euro USD on the daily, and you'll be seeing a lot of red and blue bars. And in Forex, we call these bars candlesticks. So the red candlesticks represent price falling, and the blue candlesticks represent price rising. So if you look on the bottom, we have time on the bottom axis, and this could be in minutes, hours, days, weeks and months. And then on the right we have price. So currently right now, so for Euro USD, 1 euro equals $1.11012. So for when you're looking at any currency pair, the currency on the left, which in this case is the euro, is the base currency, and the currency on the right is called the quote currency. So the base currency is always 1, and the quote currency is always what's equivalent to 1 of the base currency. So for Euro USD, 1 euro equals $1.11012. So for USD CHF, 1 US dollar is equal to 0.96095 Swiss franc. And if you look at AUD USD, so for 1 Australian dollar, we get 0.6645 US dollars. So just remember when you're looking at currency pairs, which one is the base currency and which one is the quote currency. Okay, so like I said, on the right we have the price, and we measure the difference in price in pips. So, and I'll go to more in-depth detail what pips actually are and what they represent. But for now, let me just show you. So from the bottom, from the bottom here to the top, the middle number, it shows us how many pips there are. So you can see that there is 700.8 pips. And we use this number to manage our risk and reward when we take a trade. So we'll know how much we'll lose and know how much we'll gain. And in Forex, we look at multiple time frames. So this is Euro USD on the daily time frame. So each one of these candlesticks, like this one will represent the movement of price within a day. So if I zoom in, say this candle here, at the start of the day, price was here, and then at the end of the day, price finished there. And we represent this in a red candlestick, shows price decreasing. And on the opposite, this blue candle here, at the start of the day, price was here, and then at the end of the day, it finished here. And again, we represent it with a blue candle, show price increasing. And in Forex, we have multiple time frames. So this is the daily. So we go all the way up to the monthly. So again, all these candles here represent the movement of price within a month. So again, if I zoom in, at the start of the month, price was here, and at the end of the month, price was here, and represent again with a blue candlestick. So we go all the way from the monthly to the weekly, so each candle represents a week's movement of price, daily, 4 hour, 1 hour, 30 minutes, 15 minutes, 5 minutes, all the way down to the 1 minute. So shorter time frames will be used by traders that are looking for more short term, and longer time frames like the monthly, the weekly and the daily are looked at by long-term traders who hold positions for weeks or even months sometimes. Okay, so now let me explain to you what a candlestick is in detail. Okay, so in front of you we have two candlesticks. So we've got the red candlestick here, which represents price falling, and we've got the blue candlestick here, which represents price rising. And in Forex we have a name for buyers and sellers. For buyers we call them bulls, and for sellers we call them bears. So for this candle here, which represents price falling, this is called a bearish candle, and for this candle which represents price rising, we call it a bullish candle. So in a bearish candle, price will open here, or start there, and price will close here and finish here. And this here is called the body of the candle, from where the price starts to where it closes. And the body of the candle represents how far price moved from when it started to when it finished. And at the top here and at the bottom here, these are called wicks, and they represent the highest and lowest point that price was during that time frame. So if this candle represented how far price moves within an hour, so during that hour the highest price was at this level here, and the lowest price was at this level here. And in a bullish candle, it's the opposite for where price started and closed, but for the wicks it's the same. So for this wick here, that's where price was at its lowest, and for this wick here, that's where price was at its highest. So it's the same for the bear candle. But for a bullish candle, price closed here and price started there, which shows us that price increased during this time frame. So again, here to here is the body of the candle, and this body represents how far price moved in that time frame. Okay, so a third type of candle was called the doji, and the doji shows us that price opened and closed at the exact same position. So if you look here, price opened here and closed at the same position, so you can see there's no body. Last time we had a candle that looked like this, so it would have opened there and closed here, so giving us that body. But here you can see there is no body because price opened and closed at the exact same position. And again we have the wicks, which are here and here, and again this wick here shows the highest price was during that time frame, and here this wick shows us the lowest price was during a time frame. Okay, so when you look at the real markets, candles won't always look like the candles I've just shown you. There'll be a lot of variations and candles will look different. So if you look here, you can see we have a bearish candle, price opened there and closed here, giving us that body. But you can see that this candle has no lower wick, so that shows that price didn't go past where it closed, and we have that long upper wick. So at one point price was all the way up here before getting rejected all the way down here. And again we have this candle here, which is the opposite of this candle, so the body is now on top. So again we have a bearish candle, so price opened here, closed there, and during the time frame price dropped all the way down here before getting rejected, come back and closing here, and there's no upper wick, so this is the highest point that price came to. Okay, so now we got a bullish candle here, so price closed there and price opened here, and we have very long wicks to either side, so price was moving a lot during this candle. So at one point price was all the way up here before getting rejected, and price was all the way down there before getting rejected. And here we got different types of dojis now. So this here is called a gravestone doji. So price opened here and closed at the exact same place, but during the time frame of this candle, price was all the way up here before getting rejected and come back down here, and again no lower wick as well. And on the flip side we have this which is called a dragonfly doji, was the opposite of a gravestone doji. So price opened there and closed at the exact same point. It dropped all the way down there, came back, got rejected, giving us no body and just a line, because the price open at the exact same place and close at the exact same place. Okay, so let's look at some of the technical terms now. So first up we have leverage, and leverage is basically the ratio of your money that you're trading with and additional money borrowed from the broker to increase your returns. So when we're trading in Forex, a lot of people won't have enough money to make noticeable gains in Forex. So we borrow money from our brokers, which is the leverage, so we can make more money. Let's say that you deposit £1,000 into your account and you have a leverage of 1 to 500. So that means for every £1 of your capital, you have £500 to trade with. And of course, there's different leverages you can get. You can get 1 to 100, 1 to 200. So you need to find which leverage is best for you, because if you have a really high leverage, obviously your returns will be really high, but obviously your losses will be very large as well. So you need to find the leverage where you can still get good returns, but you can still manage your losses. Okay, so next up we have margin. And margin simply is the money that a trader puts forward in order to place a trade and maintain a position. So it just proves to the broker that you have enough money in your account. So margin is a small amount of money that your broker will automatically set aside every time you take a trade to ensure that you have the funds to withstand a loss from a trade. Because sometimes you could be trading with too high of a position size and your account actually can't take a loss from this trade and it will wipe your whole account out. But remember, margin is not a fee. So when you close your trade at a profit or maybe at a loss, you'll receive all the money back that the broker automatically set aside when you took that trade. Okay, so now we're going to look into actually what a pip is. So pip actually stands for point and percentage, and it just represents the change in price of a currency pair. So for example, GBP USD has a price of 1.22016. So a pip is the fourth digit of that number. So let's just say that the price of GBP increased to 1.22096. So the price has increased 8 pips, because if you can see the numbers have highlighted red. So for the original price it was 1.22016, and now this price it's 1.22096. So the 1 has gone up 8 pips to the 9, and the 6 on the right of those two numbers is what we call a micro pip, but we're just going to focus on what pips are. So for all currency pairs, the fourth digit of the price is always the pip, but for currencies involved in JPY, the pip is actually the second digit. So for example, CAD JPY, 78.178 is the price, and let's say it decreased to 78.128. So if you look at the second digit, it's reduced from 7 to 2, so this is reduced by 5 pips. So the important thing to remember is that for every pair, including the JPY, it's the second digit, and every other pair is the fourth. Okay, so now let's look at the bid and ask price. So the bid price is the price of a currency pair that sellers are willing to sell at, and the ask price is the price of a currency pair that buyers are willing to buy at. So when you want to buy or sell a currency, there will be two different prices where you would buy or sell from. Buyers will be buying at one price and sellers will be selling at another price. And these prices are constantly changing, going up and down as price goes up and down with it. And a quick tip so you know which price is which: the bid price is always the smaller price than the ask price. Now let's look at the spread. So spread is essentially the cost of taking the trade. So you can easily calculate the spread of a currency pair by minusing the bid price from the ask price. So for example, we have GBP USD, and let's say that the bid price is 1.22015 and the ask price is 1.22025. So we minus the bid price from the ask price. So we have 1.22025 minus 1.22015, and the difference is 1 pip. So the spread of GBP USD is 1 pip. And it's good to be aware of the spread of the currency pairs you are trading, because if you have a really large spread, it will reduce your profits that you make. And if you're a day trader or a scalper, you want a really tight spread, because you're looking to grab a small number of pips and you don't want a large amount of your profit given away to spread. And at the bottom there I've listed 3 pairs: Euro USD, USD JPY and GBP USD, and all these currency pairs have lower spreads. So if you're looking to become a short-term trader, these are some of the pairs that you need to be looking at. Okay, last we have volatility, and it is simply the measure of the change in value of a currency or a currency pair. So say if a currency pair has high volatility, the price can increase or decrease quite quickly in a short period of time, and that means it's less predictable as well. A lot of the exotic currency pairs that I've mentioned early in the video have high volatility, so some people tend to stay away from them. But then again, high volatility can also be a good thing. It means that the market is moving and can increase the size of your profits. However, on the other hand, low volatility means that the change in price in the market is relatively low, so that means the market doesn't move much. So this could be a good thing because it means it's less risky. However, because the market doesn't move much, it does mean that your profits will be smaller as well. So the Forex markets are pretty big, and there are plenty of different types of traders out there, but each trader will normally fit into a specific category. Okay, so first we have position traders, and they're essentially long-term traders, meaning that they take trades and they stay in them for a long periods of time, say a few weeks or maybe a few months or sometimes years even, and they look to capture the bulk of a trend. So they look to enter near the start and exit near the top of the trend, and whilst price is doing all its up and down antics, they will stay in the trade, hoping that the overall trend will continue. Now, position traders are the least active out of all traders, and they'll be making their decisions from the closes of daily candles or sometimes weekly candles, or maybe even monthly if they're really long term, and they'll be looking to capture around 500 to 1,000 pips in the move, or maybe even more. And next we have swing traders, which are still long-term-ish traders, obviously not as long as position traders. They will look to stay in the market for around 2, 3 or 4 days maybe. Most of the time they stay in it less than a week, and they tend to act off 4-hour and hourly candles. Swing traders look to capture the smaller trends within the larger trend in the market, which are called market swings, hence the name. Now, these traders are more active than the position traders, and they'll be monitoring their trades throughout the day and looking to take maybe around 2 or 3 trades a week, whilst position traders will probably take 2 or 3 trades a month. And they typically look to gain around 50 to 150 pips in a move. And third, we have the day traders who trade intraday, meaning that they open and close their trades within the same day. Now, these traders are more active than the swing traders and the position traders I've just mentioned, and they'll be looking to get maybe 2 or 3 trades every day, and they'll be acting on time frames between the 50-minute time frame and the hourly time frame. Day traders also tend to trade at specific times in the day when the market has increased volatility, so they can capture impulsive moves, but they won't be looking to capture more than 40 or 50 pips in a trade. And last but not least, we have scalping, which is very short-term trading. So scalpers will be in and out the market very quickly in a matter of minutes, and they'll be taking maybe 5 or 6 trades every day, and they will normally be using the 1-minute time frame or the 5-minute time frame to take their trades. And like I said, scalpers are the most active out of all traders, so they have to constantly monitor their trades and won't be looking to get more than 10 pips in a trade. Okay, for each different type of trader, they'll each have their own strategy that they'll use to trade the Forex markets. So for short-term traders, their strategies will be different from long-term traders. And short-term traders will probably only look at a few currency pairs. So for scalpers, they might only look at one currency pair and only trade that pair, or maybe 2. And day traders maybe look at 5, 6 or 7. Whereas long-term traders will probably look at a wide range because their trading setup occurs less frequent than for short-term traders. So they look at a wide range, so they have enough opportunities to trade to meet their goals. So if you're just starting out trading Forex and you're a beginner and you're wondering which type of trader you should become, then you need to assess your situation and what commitments you have going on. Because say if you're in full-time education or if you have a full-time job, you'll be quite occupied and busy during the week. So maybe choosing a short-term trading strategy might not be the one because they're more intense and you have to be quite active in the market. So maybe going for a more long-term strategy like position trading or swing trading will probably be better suited for you because the income is more passive and you don't have to constantly be looking at the charts. You maybe check your trades at the end of the day or after every 4 hours, so it gives you a lot more free time. On the other hand, if you have a lot of free time already and you don't have commitments that require much time, then maybe you can go for more short-term trading style like day trading or scalping, which means you'll be more active in the market and requires more attention, and because you've got the free time you can afford to do so. But make sure you factor in your preferences as well, because let's say if you do have a lot of free time, then you can afford to spend the time needed to learn how to day trade and scalp maybe. But the idea of having to constantly monitor your trades and be active trading every day might not be up your alley, and that might put you off trading and you prefer more of a passive way. Then by all means learn more of a long-term type of trading like position trading or swing trading. But you need to make sure that you're aware that learning more of a long-term type of trading, like position trading and swing trading, will take a lot longer to learn because you'll be waiting on the closes of daily candles. So you'll be making your decisions at the end of the day. Whilst if you were to start with maybe day trading, and you can transfer your skills from day trading to swing trading or position trading even, you'll be waiting on hourly candles, maybe 15-minute candles, and you'll be learning a lot quicker because the candles will be closing quicker, you'll be making more decisions, you'll be taking more trades and learning from your losses and learning from your wins more often than if you just dive straight into long-term trading. So at the time we film this, we're currently in quarantine, so a lot of people who are in full-time education or who have a full-time job won't be very busy right now, so you have a lot of free time. So I could recommend, because after quarantine you'll probably be going back to your job or going back to school or university, so you won't have a lot of time on your hands on the future. So I recommend learning from hourly charts or 4-hourly charts, so you'll be more active and you will speed up your learning a bit more than if you just focus on daily charts now. And then when your commitments are back up and running again, you can transfer your skills that you learned on lower time frames and transfer them to the higher time frames. Okay, so now you know the different types of Forex traders. Now we're going to look at the different ways traders speculate whether the price is going to increase or decrease. So in Forex we have 3 main types of analysis. We have fundamental analysis, technical analysis, and sentiment analysis. So first we have fundamental analysis, which doesn't really focus on what's going on with the Forex markets. It looks more at what's going on with particular countries and the situations around the world. So it will take into account interest rates, economic updates, political matters, natural disasters, and everything I've just mentioned will have its own impact on particular countries, which can then impact the value of their currency, whether it will increase in value or decrease in value. And people will also look at different countries' economic future to help make their decisions. So if a country has a particular good economic future, different markets may rise or fall in anticipation to this. And next we have technical analysis, which focuses on what's actually going on in the Forex markets, and it includes support and resistance lines, trend lines, moving averages, different indicators, just to name a few. And last we have sentiment analysis, which focuses on the positions different traders have taken in the market. So it would look at whether there are more buyers than sellers in the market or vice versa. Now sentiment analysis is mainly used by longer term traders, but technical analysis and fundamental analysis is used by everyone. And remember that people analyze the markets in different ways. Some people might use fundamental analysis, technical analysis, and sentiment analysis to make their trading decisions. Some people might just focus on one or use 2. I personally just focus on technical analysis as that works best for me and gives me the best gauge in the market. Okay, so now let's take a look at the particular times that people trade Forex in a day. So in Forex, volatility is quite important because it makes the market move, and if the market didn't move, no one would make any money. Obviously no one would lose any money, but we wouldn't make any money either. So volatility is quite important, and especially for short-term traders like day traders. So as a result, many traders will try and trade at specific times in the day when the market has a bit more volatility in it, so they can take advantage of it. So in Forex we have 3 main trading sessions: the London session, the New York session, and the Asian session. And when the trading sessions open, there tends to be a surge in volatility in the Forex markets because there are a lot more active traders during this period. So for the London session, it opens at 8 AM and closes at 4 PM GMT. The New York session opens at 1 PM and closes at 10 PM GMT. And the Asian session starts at 12 AM and closes at 9 AM GMT. And obviously if you don't live in the GMT time zone, then the times I've just mentioned will be wrong for you. So you can just search it up on Google and the correct answers for your time zone will appear. Okay, so now we're going to look at how you could take a trade and place an order. So there are different types of orders in Forex. So first up, we've got the market order. And this is a buy or sell order that is executed immediately at the current price of the market. So on your trading platform, you probably have a buy and sell button. So if you're using MT4, it's located here. So if I was to click the buy button now, I'll be entered into the trade immediately and I'll have a buy order at the current price. And if I was to hit the sell button, I'll be entered into the trade immediately again and I'll have a sell order at the current price. So market orders are just used to get you in the market immediately and at the best available price. Okay, so the benefits of using a market order is that you can act quickly and place a trade as soon as you see a potential setup. However, sometimes price does change quite quickly. So as you're entering your trade, price could fluctuate and end up at a different price, a less convenient price for you, and then you would have entered the market at this price. But most of the times the price of a currency pair won't change too drastically to have a big impact on your trading. Next we have the limit order. A limit order is a type of pending order which you enter the market at a later time. So unlike the market order where you execute the trade immediately, with a limit order you will enter the trade later and it will be at your desired price. And a buy limit is placed below the market at your desired price, and a sell limit is placed above the market at your desired price. So like I said, limit orders are pending orders. So if you look at the current price here, if I was to enter a buy limit, I could enter it around here, let's say. So if price came down and touched my buy limit order here, I'll be entered into the trade, and obviously if the price goes up, I'll make money, and if the price continue going down, I'll lose money. And for a sell limit order, let's say that I have my sell limit order here. So if price was to come up and touch my sell limit order at that price, I'll be entered the trade. And again, if it was to sell off, I would make money, but if it was to carry on and go straight through, I'll lose money. So the benefits of using a limit order is that you can enter at your desired price and a better price than the market's currently at. So if the market's trading at too high of a price, you can simply enter a limit order and wait for price to drop to a lower price and get triggered in. So now you'll be in a better position. And another benefit of using a limit order is that it allows you to control your emotions, because sometimes people might have the fear of missing out, or they might want to try and make money back that they lost on the previous trade, so they might enter trades that they'll later on regret. And using a limit order means that you'll be entered into the market at a later time, so all the emotions that you had at that moment would have gone, and you can actually focus on what you're trading. On the other hand, there are some disadvantages to using a limit order. Sometimes you can miss a move in the market because price didn't fall far enough to reach your limit order to fill you in, so price could reverse without you and you miss the trade. Is that you could be in a situation where price is falling with a lot of momentum and it goes straight through your limit order, and you could suffer quite a bad loss if you don't exit the trade quickly. And now we have the stop order, which is another type of pending order which you enter the market at a later time, so similar to the limit order. And a buy stop is placed above the market at the desired price and activated when the market reaches your specified price. And with a sell stop, it's placed below the market at your desired price. So now with stop orders, it's the exact opposite of a limit order. So if I was to place a buy stop, I would place it, say, around here. So if price was to come up and hit my buy stop and keep going through, I would make money. And if price was to reverse and come back down, I would lose money. With a sell stop, so I was to place it here. So if price traveled all the way down to my desired price and it was to keep going through, I would make money. But if it was to reverse at my desired price and go up, I'll lose money. So it's up to you to decide which type of entry order you would like to trade with. Stop orders are quite helpful when trying to trade breakouts. And a breakout is basically when price is consolidating and ranging on a level, and then it breaks out in one direction with a lot of momentum. So placing a stop order above or below the market, depending on which way you think the market will break out in, can be really helpful for your trading. However, by doing this, you can fall a victim to false breakouts, which is when price breaks out in one direction, will fill you into the trade, and then get rejected just to break out to the other side. And finally, we have a stop loss order, and a stop loss order is placed at a specified price to exit you from a trade. So unlike the others we've just looked at, which are to enter you into the trade, a stop loss order is to exit you from a trade. And a stop loss is used to prevent any further loss when a trade is going against you. So sometimes you have a losing trade and you could use a stop loss so you don't lose any more than you want to, or maybe you're in profit and you don't want to give too much away of your profit, so you use a stop loss order to protect your profit. Okay, so a stop loss order can be used with any other type of entry order, so it doesn't matter if your order is pending or not, you can still use a stop loss order. Okay, so let me give you an example of what a stop loss is and show you how it actually works so you can understand it. So price is here, and let's say I was to go short in this market and I enter the market at the current price here. So I could place a stop loss to protect myself so I don't lose too much money, and so I place it here. So obviously if price was to keep falling and sell off, I would make money, but if price was to reverse and go against me, if price was to hit where my stop loss is, I would be automatically exited from the trade and I would take my loss. So a stop loss essentially is to protect your account and your funds. Right, so let's look at the lot sizes now and understand what they mean. So in Forex, a lot of traders will trade with certain amounts called lots, which is a number of currency units you would trade with. So a standard lot size is equal to 100,000 units of currency. And the reason the number is so large, because in Forex, the price of currency pairs don't change too much and it's quite minuscule. So when you're trading Forex, you need to use a lot of units of currency to generate a noticeable amount of profit. So a standard lot size is equal to 100,000 units of currency, and we also have three more. A mini lot size is equal to 10,000 units of currency, a micro lot size is equal to 1,000 units of currency, and a nano lot size is equal to 100 units of currency. So the lot size that you trade with, so basically how many units of currency you're trading with, will dictate how much your profit is and also how much your loss is. So two different traders can place the exact same trade at the same time, but because the first trader trades with a larger lot size than the second trader, the first trader will make more money, even though they both gain the same amount of pips. But on the other hand, if their trades failed, the first trader would suffer a much larger loss than the second trader who traded with a less lot size. And now let's look at calculating your wins and losses. So to calculate your profit and loss, you need to multiply together the value per pip of a standard lot, the number of pips, and the number of lots you used. So let's say for a currency pair like AUDUSD, you've gone long and the value per pip is at $10. So you'd make $1,000 from that trade. So to find the value per pip of a standard lot, you could probably just Google it and find the answer, but I'm going to show you how to calculate it here. So let's find the value per pip of USD JPY. So first we multiply a pip by how many units in the standard lot, then divide it by the current price of that pair. And as you can see, I've written that down in blue. So since this is a JPY pair, the pip is the second decimal. So it's 0.01 times 100,000 divided by 119.80. And that gives us $8.34 every pip. So let's say you placed a trade on USD JPY and you made 100 pips and you were trading with two lots. So I'd multiply all these together to find out your profit. So $8.34 times 100 pips times two lots equals $1,668. So that's how much you'd make from that trade. But when calculating the value per pip for currencies that don't start with USD, it's slightly different. So let's look at USD for example, and let's say that the current price of EUR/USD is 1.1930. So like USD JPY, we multiply a pip by the number of units in the standard lot and divide it by the current price. But this time we now multiply our answer by the current price again. So for EUR/USD, a pip is to the fourth decimal, so it'd be 0.0001 multiplied by 100,000 and then divide by 1.1930, which equals 8.38. Then we multiply that by the current price and we get $10 per pip. And then we can do that exact same for GBP/USD and we get $10 per pip as well. So for currencies like GBP/USD and EUR/USD, the value per pip is normally around the $10 mark. Right, so let's look at swap. So swap is the interest that you earn or you have to pay for holding onto a trade overnight. So you can make money or lose money from swap. And to make money from swap, you need to have a positive swap, which means that you receive money as the interest of the trade you're holding onto is larger than you're required to pay. And on the other hand, you can lose money from swap if you have a negative swap, which means that you're still required to pay interest on your trade and it will be subtracted from your account. So if you're a swing trader or position trader and you're planning to hold on to a trade for a few weeks or a few months, it's good to know whether you'll be making money or losing money from swap, because over a long time it does start to pile up. However, if you're a day trader or a scalper, you'll probably avoid swap costs completely because you'll be opening and closing trades within the same day and you only have to pay or receive money from swap if you hold it overnight. Okay, so we're going to take a look at brokers and trading platforms now. So there are plenty of brokers out there and each broker is slightly different from the last. So you need to choose the broker that is right for you. If you're wanting to become a long-term trader, then you won't be too worried about commission costs and high spreads because you'll be looking to hold trades for a long time. Whereas if you're a scalper or day trader, high commission costs and high spreads will really damage your trading progress. Also make sure that the broker you choose is regulated, because if it's not, you might have troubles in the future, such as withdrawing or depositing money, and because the broker is not regulated, it can technically do what it wishes. And also check the minimum deposit that the broker allows. Some brokers will allow $200, some will allow $100, so depending on how much money you have to trade with, some brokers might be off the table temporarily. So in front of you I've listed 2 brokers, XM and Forex Time. Both are good brokers, both regulated, so I recommend you check them out, and I'll leave links to them in the description. Okay, so now for trading platforms, and at the bottom there I've listed 4 different trading platforms: MetaTrader 4, which I've been using throughout this video, CTrader, TradingView and NinjaTrader. Now all of these trading platforms are good trading platforms. MetaTrader 4 and CTrader are free, and you can download them from a few brokers. XM and Forex Time both use MetaTrader 4, so you can download it from them. However, TradingView and NinjaTrader are paid platforms. They do have free versions, which are not bad, but to have access to their full tools and to the full platform, you need to pay for it. So it's up to you to decide which platform is best for you. In my opinion, MetaTrader 4 is really good and has everything you need to trade Forex with. Okay, so now you understand what Forex is and what it's all about. Now I'm going to talk to you about the steps that you can take to get you started with your own Forex journey. So in my opinion, the best way to get started with Forex is just to dive straight in, start trading, start getting some experience on your belt. And the best way to do that is to open a demo account. And a demo account is basically a real account, but with fake money. You'll be trading the exact same markets as everyone else, but the only difference is you'll be using fake money. Now, both the brokers I've mentioned in this video, and I'll leave a link to them in the description, both offer demo accounts, and they're completely free. You don't have to pay for a demo account. It's completely free. All you have to do is sign up and you can start trading right away. And you get to pick your own account size, so how much you'll be trading with. So obviously if you're going to be, well, when you advance to start trading with real money and you have $1,000 that you're going to use for that, you don't want to be opening an account size of 100 grand, because it's not going to get you comfortable trading the capital that you actually be trading. Now on a demo account, it's okay to make mistakes because no money's actually on the line. You have no risk. Obviously, if you had a real account, you pay for your mistakes in real money, literally. So with a demo account, don't be afraid to make mistakes. Everyone will make mistakes when they're starting out. Trading is hard and it's complicated when you look at it from a beginner's point of view. But after a while, you start to adapt, start to get more comfortable, and you understand what's actually going on. So with a demo account, you want to be testing different strategies. You want to find out which strategy works best for you and which strategy do you understand the best. And once you've found that, then you need to work on your consistency and come up with a structured trading plan that you can follow and carry out. And you just need to be focused on learning, improving yourself as a trader, and getting as much experience on your belt as possible. Because when most people start trading, they're not expected to make money straight away, and that goes for you as well. You're not expected to make money straight away. So after a couple months and you find that you just keep losing money, don't lose sight of the goal, because that's expected. Because with Forex, it's a very hard and slow grind, but you need to remember that anyone can do it. Anyone can become a successful Forex trader. Every successful Forex trader is just someone who can make more money than they lose consistently. And that's it, there's nothing else to it. All they do is make more money than they lose consistently over long periods of time. And also make sure you're subscribed, because I'll be doing a lot of videos about technical analysis and different strategies that will definitely help accelerate your journey in becoming a successful Forex trader. And don't forget to check out my previous videos about support resistance lines and engulfing patterns, because they'll definitely help if you're learning. Okay, so thank you for making it to the end of the video. I know it's been a very long one, and if you made it to the end, I'm very, very proud of you, because the odds were against you, but you made it, so well done. So today you've covered all the basics to do with Forex trading. You know who trades it, the different types of analysis, the different trading sessions, the different type of traders. You learn all of it, so I know it's been a lot to take in, but the most important thing to take away from this video is that you need to open a demo account to start your journey. Because for every successful Forex trader, they always have to take that first trade to get them on that journey. Whether if it's a real account or a demo account, they always took that first trade. So make sure you open an account, it doesn't take too long, and you have nothing to lose. So again, thank you for watching, and if you haven't done already, make sure you subscribe, like, share, and hit the bell so you don't miss an upload. And please comment if you found this video helpful or if you have any questions. But till next time, I'll see you later.